Oil has been confidently gaining value for the second week in a row. Yesterday, the asset managed to overcome the high posted on October 25th, settling at $87 per barrel. Its drivers are still growing demand for petroleum products and supply that lags far behind it. Oil production remains restrained, which leads to an increasing risk of real energy shortages. Fundamentally, there are no statements capable of calming the growing excitement. Therefore, the outlook for oil growth remains quite high. From a technical point of view, Brent oil futures crossed the local high of $86.68 per barrel, reaching the levels of 2014. This suggests that the oil market remains in a pretty solid uptrend. In this situation, it can be assumed that the quote will most likely head for the psychological level of $100. However, the asset is extremely overbought, which in turn may lead to a number of technical pullbacks. As for the foreign exchange market, the ruble is still weak. The Russian currency loses value and gains again, echoing the Moscow Exchange Index. Its decline to 3,500 points resulted in the dollar's rally to 76.75 rubles, while its growth to 3,550 points led to the strengthening of the Russian currency. This synchronized movement clearly demonstrates that the situation in the foreign exchange market stems from capital outflows. Foreign investors get rid of riskier assets, leaving the Russian market. Another question is whether this process has ended. Judging by the recovery of the ruble-based MOEX Russia Index, it appears to be over. If so, the ruble has every chance of posting slight gains, given its oversold status. In the meantime, the dollar-ruble pair has slowed down its pace of strengthening in the area of 77.35 rubles. The trading instrument has pulled back and is now stagnant. The pair will most likely continue trading within a sideways channel, limited by the levels of 75.60 and 77 rubles per dollar. In this case, the best trading tactic is to use a breakout strategy. Likewise, gold continues drifting within a sideways range. However, its lower boundary has moved to the level of $1,815 per troy ounce. This is not the first time the asset has run into this mark and then rebounded to $1,830. Obviously, gold will hardly be stuck in such a narrow channel for a long time. The precious metal has already made futile attempts to break through the barrier of 1,830 more than once. This means that its growth potential has been exhausted. Thus, gold prices are likely to go down in the near future. Meanwhile, the trading instrument remains range-bound, showing extremely sluggish dynamics. Gold prices are moving within the range of $1,811 and $1,830 per ounce. Thus, the best tactic is to trade with a view to breaking through one or another range boundary. If the price fixes below $1,809 on the 4-hour chart, gold will most likely extend losses. In case the price consolidates above $1,835, the precious metal will have a chance of gaining value. So now you know about possible future asset movements and their grounds. So choose your strategy and make a profit. Have a profitable trading day and see you back soon.